Welcome to Season's blog. Bull or bear, we don't care. A manifesto. No qualifiers, no asterisks, no fine print. Most crypto projects won't dare utter them because they can't survive the test. But with Bitcoin shedding over 50% from its October highs and $2+ trillion evaporating from crypto's total market cap, these words are the only ones that matter. Bull or bear, we don't care. This is the story of our tagline, thesis, and mechanism. Told in 3 acts. Act 1, the crash, February 2026. Bitcoin, Ethereum, Solana, everything is down over 50% from the October 2025 highs. The fear and greed index has consistently been in the extreme fear zone, reaching a low of 5 earlier this month. That's lower than the post-FTX era. What reached new heights, though, is global uncertainty, and so have liquidations with trillions of dollars, leaving crypto in the past couple of months. Analysts have started asking if this is the end. Spoiler, not really. Emission-based yield sources are the most vulnerable to the shockwaves in such situations. When prices collapse, the tokens they use to pay yield lose value in tandem. Their mechanism itself breaks down, in fact. Staking and lending APYs compress as capital flees, and borrowing demand fades. The stunning yields that attracted users in the good times disappear precisely when they're most needed. It's a cruel irony baked into the architecture. And the plus 90% compression in DeFi yields since the 2020 summer, from 100 to 1,000% to 3 to 8%, is how this irony manifested itself. Meanwhile, at Seasons, the distributions happen on schedule, undeterred, because our mechanism doesn't care what Bitcoin is doing. Every trade, buy or sell, feeds the system. Price doesn't matter. Panic selling? That's transaction volume, which generates fees, so the yield continues to flow to nodes. What's more, while the rest of crypto experienced one of its most severe and coordinated market-wide drawdowns since 2022, Seas grew steadily by over 6%, proving our thesis under live fire. Bull or bear, we don't care. Act 2, the rally. Now flip the script. Markets rip upward. Bitcoin reclaims 6 figures. Euphoria floods back in. Everyone's a genius again. In traditional yield models, rallies create a different kind of trap. Capital floods into protocols, diluting yields for existing participants. Aave's TVL expansion from 0 to over $35 billion in under 5 years compressed its APYs by 70 to 75%, whereas the 146% surge in Ethereum's validator count since 2022 pushed staking rewards from 5 to 6% down to the current 2.5 to 2.8%. More participants, same rewards pool, thinner slices for everyone. Moreover, bull markets also breed over-leverage. The same excess that fueled October 2025's all-time highs planted the seeds for this year's liquidation cascade. As complexity compounded, yield seekers stacked positions across multiple protocols and asset classes using borrowed money. This created dependencies that led to, and will lead to again in the future, everything, everywhere, going down all at once. And the post-frenzy meltdown we're witnessing right now is a lesson in what happens when excessive leverage and intertwined risks meet widespread liquidity stress. Meanwhile, at Seasons, the distributions happen on schedule, undeterred. During bullish rallies, rising prices attract more buyers. More buyers mean more transaction volume. More volume means more fees captured, more yield generated, and richer distributions flowing to nodes. No dilution problem because fees scale with activity, not inversely with capital. No lockup trap because your yield arrives as liquid, diversified assets you can deploy however you choose, while your principal remains intact and productive. Act 3, the flatline. This is the scenario nobody writes manifestos about. The market goes nowhere. Prices chop sideways. Volatility is low. Headlines dry up. For emission-dependent models, sideways markets are slow suffocation. During the post-2020 slump, for instance, Convex's boosted APYs collapsed from 10 to 40% to below 1%, as emissions tapered, that is, a 91% decline. Without price momentum to maintain the illusion, the math caught up quietly, but surely. TVL drained away. Emissions schedules ran out, and what took over 40 years to materialize in TradFi happened in about 4 years in DeFi. Chronic yield compression with increasing complexity. Meanwhile, at Seasons, the distributions happened on schedule, undeterred. Quiet markets may not have the pomp and show of bull runs, but they do have movement. Sideways chop activates rebalancers. Arbitrageurs cycle in and out. And all these transactions, regardless of conviction or direction, generate fees. Seasons' mechanism doesn't depend on hype or noise. It capitalizes on activity. And activity, unlike short-term sentiments, never truly dies. When the tagline is the thesis. For decades, yield seekers have been trapped between forces they can't control. Central banks printing trillions of dollars, compressing yield alongside rising living costs. DeFi promising liberation, but inheriting TradFi's fundamental flaw: excessive dependence on price and policy. Instruments offer extraordinary yields, then collapse as the math unwinds. Tied to external conditions, such systems only work until those conditions change, and conditions always change. Seasons was built on a different premise entirely. Yield must be earned through real economic activity, not printed out of thin air. It must flow, regardless of whether charts point up, down, or sideways, arriving in your wallet as liquid assets you actually control. Without complexities, and most importantly, without locking up your capital for days, months, or years. Launching in a cold December and growing through a colder, bloodier January, we've distributed over $82,200 in total yield to 278 nodes so far, across 21 rounds. Not because we got lucky, but because we designed Seasons architecture exactly for this. Markets will rise, markets will fall, markets will do absolutely nothing for stretches that feel endless. But simple, sustainable yield must keep flowing. Bull or bear, we don't care. Seize the yield.